The US dollar remained steady on Tuesday as a sharp sell-off in global bond markets showed signs of stabilizing. Investors have been closely watching the bond market, which had been in a prolonged downturn due to shifting expectations around central bank policies. The dollar found some support as yields on government bonds in the US and Europe paused their climb. This pause in the sell-off is significant because it suggests markets are beginning to adjust to the possibility of a slower pace of rate cuts from the Federal Reserve. The yield on the benchmark 10-year U.S. Treasury note held near 4.3%, down from recent highs above 4.5%. This stabilization provided a floor for the dollar, which had come under pressure during the height of the bond rout as investors sought safety in other currencies. Traders are now pricing in a roughly 50% chance of a quarter-point cut at the Fed's May meeting, down from near certainty just a month ago. Meanwhile, the Japanese yen weakened past the 150 level against the dollar, despite Japan reporting stronger than expected economic growth for the fourth quarter. Japan's economy expanded at an annualized rate of 2.8% in the October-December period, beating consensus forecasts of 2.3%. The data, released early Tuesday, was driven by robust business investment and a recovery in consumer spending. However, the yen failed to gain traction, sliding past the psychologically important 150 level against the dollar. Analysts attributed the currency's weakness to the persistent interest rate differential between Japan. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. And the United States. The Bank of Japan has maintained its ultra-loose monetary policy stance, keeping short-term rates at -0.1%, while the Fed has held its benchmark rate at 5.25% 550%. The yen's inability to rally despite strong economic data highlights the power of interest rate differentials in shaping currency movements. The dollar's stability in the face of broader market uncertainty is a key development for traders and investors to monitor. As bond yields stabilize, the dollar is finding some respite from the selling pressure that had pushed it lower in recent weeks. This is important because it reflects a shift in market sentiment and expectations around central bank actions. The dollar's performance is closely tied to the broader economic and monetary policy landscape. And any changes in that landscape can have ripple effects across global markets. The bond market's pause in its upward yield movement is a sign that investors are recalibrating their expectations. This is a critical development because it could signal a broader shift in risk appetite and economic outlooks. The dollar's strength in this environment is not just a function of U.S. policy, but also the relative weakness of other currencies, such as the yen. The yen's slide despite a strong GDP report is a reminder that economic fundamentals alone do not always dictate currency movements. Other factors, such as monetary policy and global risk sentiment, can play an equally important role. The Bank of Japan's decision to maintain ultra-loose monetary policy has created a stark contrast with the Fed's more hawkish stance. This divergence is a key driver of the yen's weakness and is likely to remain a focal point for currency traders. The dollar's ability to hold ground amid these dynamics is a sign of its resilience and its role as a safe haven asset in times of uncertainty. Investors are now watching closely for any new signals that could indicate a shift in the bond market's trajectory or changes in central bank policy. The next key signal to watch is the outcome of the Federal Reserve's May meeting. Any indication that the Fed is leaning toward a rate cut could reignite the dollar's downward pressure, while a more dovish stance could reinforce its stability. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The bond market's behavior will also be a key indicator of investor sentiment and expectations for future monetary policy. As the market digests the latest economic data and policy developments, the dollar's performance will remain a central focus for traders and investors. The yen's continued weakness, despite a strong GDP report, is a reminder that currency movements are often driven by a complex interplay of factors. The dollar's stability in this environment is a positive sign for those who see it as a safe haven asset, but it also highlights the uncertainty that remains in the broader financial markets. The next signal to watch is the Fed's May meeting and the direction of bond yields, as these will likely determine the dollar's next move.